So my name's Chris Hugbin. I run the active equities business at Alliance-Bernstein, and I've been with the company for 20 years. Yeah, so at Alliance-Bernstein, we take a fundamental bottom-up approach to research and finding investment opportunities, from where we then construct portfolios. We then give very careful top-down risk oversight to ensure that the portfolios are well positioned to deliver the risk-adjusted returns that our clients expect. What we saw last year is the markets be driven very much by macroeconomic factors, and we saw broad derating of valuation multiples across the market. So really that's given us opportunities to invest in individual stocks that we think sold off with the market but have much better prospects. Particularly our analysts are often looking for companies that have quality characteristics. So companies with competitive advantages, with strong management teams, with a good pipeline of innovation, where we believe they can consistently deliver good earnings and cash flows for investors. And it's those kinds of stocks that we've been increasing allocations to. We're able to find those across sectors. We can find them in technology and consumer and healthcare, but it's really that focus on quality that's been most important to our investors in recent quarters. I think the market moves we've seen at the beginning of the year really reflect investor optimism around the macroeconomic outlook. I think, however, a lot remains uncertain. While inflation is coming down, it remains at somewhat elevated levels. There is uncertainty about when, if and when the Fed will start to will pause and then ultimately start cutting rates. So I don't think that the market that we've seen in January will persist through the year. I think it warrants a little bit more caution than that, given the uncertainty from a macro perspective. Clearly, the story last year, or the driving forces last year, were the fact that inflation became so high that the central banks around the world started to increase interest rates. I think two things will be important this year. One will be what happens to inflation, and specifically in the US, what happens in the labor market, because it's really that wage inflation that drives so much of a longer term inflation expectations. I think the second thing that will be really important is what happens to the real economy. We know that the interest rate rises from last year will take a certain period. It's typically 12 to 18 months to start to impact the real economy. So we'll be looking very closely at how the economy and, most importantly, corporate earnings react as we progress through 2023. Look, I think this year, given the macro uncertainty, actually the key thing is to remain diversified. And we'd recommend an approach that blends both exposure to growth and to value, with some core exposure there as well. As I mentioned earlier, we think the key factor that's going to work, and this is true across growth and value, is going to be quality. So it will be finding those companies that we talked about that have strong competitive advantages, high returns, the ability to reinvest. There's really that quality exposure across style factors that will be important in a market like the one we anticipate in 2023. Yeah, so I think compared to the US market, emerging markets and the Asian markets look attractively valued. I think we also benefit in the Asian markets from the reopening in China. That's such an important driver across the Asian economies. And while we've seen the initial rebound as China reopened late last year, we know from other markets around the world that reopening will broaden out. Moreover, we're potentially in a position where the US dollar has peaked, may depreciate this year. And if that's the case, it gives a further impetus to emerging markets. Moreover, it's important to remember that China is at a very different point in its macroeconomic cycle than almost any other major economy. It's not in a position where it has to raise rates, but is in a position where it could further stimulate the economy. So we see lots of reasons to be positive on the Asian markets. Clearly, the Korean market is going to be heavily tied to technology and the semiconductors, sector, and really the health of that sector is really going to be driving a lot of the overall market movement this year. Sure. So firstly, let me say the dollar may have peaked. Look, clearly we're seeing a little bit more interest in fixed income, given where rates have moved. But we do think it's important to remain invested in equities. We think that there are compelling opportunities in equities, as we talked about earlier, particularly companies with more of a quality focus. Moreover, as we enter a regime where interest rates are higher than they have been for a couple of decades, where inflation is likely to be higher than it has been for the last couple of decades, that should be a macroeconomic regime in which equities can perform. Let's remember, equities are a real asset, so should form a key part of any portfolio. Sure. So firstly, I think that quality is something that cuts across different styles. So I think you can find quality growth companies. I think you can find quality value companies. So it really, to me, is around trying to find that set of companies that can kind of consistently deliver. It is important, I believe, to construct portfolios that are aware of levels of valuation and are risk aware, obviously with to match up with the style preference of any individual investor. I mean, look, I think there are many themes that will be relevant. The question is, which themes will endure the longest? One of the themes that we find quite pervasive across our portfolios, across regions, is that of climate change. Bringing that closer into the region, if you look at China's commitment, for example, to be net zero by 2060, that's going to create some incredibly significant investment opportunities as China goes through that energy transition. So finding investment opportunities that align with that long-term goal or theme will create good opportunities for investment. There are other ways to play climate in different areas of the world, but I think that example in China is a real key theme that will remain very relevant to investors for many years. I agree. Look, I think as an active manager, we need to do three things to prove that we have a superior or differentiated product to passive. The first is we have to deliver returns, right? And if we deliver returns above and beyond the index, there is a reason for investors to consider active. The second is, as an active manager, we are able to integrate ESG considerations. At the moment, data around ESG issues is pretty incomplete and often not very good. But as a fundamental research, with a fundamental research process, we can investigate those issues and identify opportunities and risks and factor those considerations into our investment decision. And that's something that passive funds struggle to do at the moment. The third area where, as an active manager, we can do something different is that we can engage with companies to influence outcomes. Okay. Again, having fundamental research allows us to understand the issues and allows us the right to engage with corporates around how they should evolve their businesses. And through engaging for outcomes, we can lead to better returns. So I think those three things will continue to distinguish good active managers from passive. So that's exactly what we at AllianceBernstein are focused on delivering for our clients. Look, clearly there's going to be near-term uncertainties around the semiconductor sector, and as we know, it is it will always be a cyclical sector. That said, we do hold positions in the semiconductor industry. One just needs to be selective about which companies to invest in at each point in the cycle.